How's everybody doing today? My name is Matthew Owens. Thank you guys very much for joining us tonight to learn a little bit more about creating financial freedom through real estate, through rental real estate. I am really happy to be able to teach this course. I think it's one of the most important topics that people can learn when it comes to real estate investing and understanding how to really solidify financial freedom for themselves. The different methods that can be used with regard to financial freedom are very key to understand in order to actually achieve this for yourself. And today I'll be going over a lot about financial freedom, as well as some of the specifics with regard to the real estate aspects of it and how you can utilize real estate to create that financial freedom for yourself. It seems like a very far off type goal to achieve, and a lot of times it may be, if you don't have the right education and the right background, the right resources and team to do so. So I'm going to teach you guys a little bit about how to get ahead and how to really be able to streamline your investment process and be able to get to the position that you want to be much faster than you've ever thought would be possible. To give you a little background on myself, my company is OCG Properties. I am a California licensed CPA and a full-time investor. I graduated from UC Santa Barbara with an emphasis in accounting. I'll just admit that it was fun in Santa Barbara. I lived in Isla Vista there for a while, so it was a lot of fun living up there and having to go to the library to study during dead week because your roommates are partying the whole time. So it was a great experience though, and I would recommend it to anybody to go up there, especially during Halloween. So a little bit about my real estate experience. I've actually purchased a little over 500 houses in the last 9 years. I quit my CPA firm job about 9 years ago, where I got my first deal under contract that I was going to make 30,000 on. And I was making good six figures at my CPA firm, and decided to go into real estate full time because I was making such a big chunk of my salary on one specific flip. And so jumped in head first in 2006. The perfect time to jump into real estate full time, not knowing anything about the market. So lots of learning curves as you go through this investment, these different investment strategies and things that you're trying to do in real estate and investing. So I'm currently buying about 5 houses a month. I've raised a little over 45 million in private investor capital. I currently own and manage a little bit over 200 units, mixed with single family and multifamily properties out in the Memphis, Tennessee market. I also invest in Indianapolis on a small scale, as well as Atlanta on a small scale. I own a renovation and property management company out in the Memphis market, which is very, very key for having a successful long-term real estate experience is that management and that renovation piece. So I decided, for my quality control purposes, to bring those two aspects in-house instead of going exterior. Now, we have a great management company on the outside, but I retain a substantial amount of control over that management company because of the fact that I have a lot of assets with that outside management company. So that's one of the biggest challenges with real estate investing, is management and the renovation side. What I help a lot of clients with is real estate taxation. I don't do taxes because for clients, because I don't like paying the government any extra money or helping people pay the government money. At the same time, I help clients with their tax structures, with understanding their tax mitigation strategies and things like that. I also do a lot of residential and commercial investment analysis for clients. A lot of clients come to me when they have a deal under contract that they're trying to understand and trying to see what the profitability is. So I'll help them with those different strategies. I help them with the lending consulting because I am involved in a substantial amount of lending opportunities from my clients, as well as always looking for new lending sources that can help us to help our clients. I do a lot of management consulting. Running a management business, you see the way management should be run and the way it can be run sometimes from outside managers. I went through 5 management companies out in the Memphis market, and a lot of times they can be good and bad in different ways. And so it's very important to understand what a good manager is. I help clients with cash flow analysis and market value analysis. their legal and legal structuring and their deal structuring as well. Understanding deal structuring can really get you far, far ahead when you're investing in real estate. So I would specifically urge you to pay close attention to the different deal aspects of this. We'll talk a little bit further on how to structure deals later on in the presentation. But we also do a lot of educational events and seminars and webinars just like this, just to teach. And what do I get out of it? I get a ton of great relationships. I don't necessarily expect anything out of these types of educational presentations. At the same time, people come to me out of them because I've added value. I've showed them how to invest, and I've showed them some of the specific things that I can teach them. So I also invest in different real estate syndications as well. So syndications are more of a pooling of investor capital together. So I've done that in the past. Before real estate, I actually worked for a couple of real estate or a couple of CPA firms that focused on the real estate investment side. So I would do corporate and individual taxation. I would do audits and internal control reviews for various real estate clients when I was working in investing. So it's kind of plays right into this as far as the due diligence aspects of things. I think it's really important to understand the due diligence, and that's kind of that experience that it gave me. So a little more about what we do. We buy single family and multifamily real estate and invest in other real estate related assets, promissory notes, and other syndications like I just talked about. We do primarily value add. So we renovate, we do value add through proper management and proper efficiencies on that management, proper leasing, the due diligence, and really that entire investment planning section of investments. So we do a lot of passive cash flow investing, whether we're selling investment properties or helping other investors invest through joint ventures with us. We provide cash flow investments that create this type of financial freedom for ourselves and our investors. So, and then we do the support aspects, of course, the investment and goal planning, tax planning, entity structuring, all of the stuff I just discussed about helping investors do this, because you need viable team members in order to achieve this type of success in real estate. Let's go over a little bit about what we're going to do, what we're going to talk about today, the primary things that I think are really important. We're going to talk about what is financial freedom in the first place. What is the entire goal here? And some specific requirements for financial freedom. You can't expect this just to come to you. There's specific things that you need to do as an investor to set yourself up for financial freedom and to be able to do more real estate investments or find new businesses and things like that that you can create cash flow for yourself. We're going to talk a little bit about why real estate, what makes real estate special versus other asset classes. Talk about the leverage associated with it as well and why that's so powerful. And we're going to go over some of the specifics of the different asset strategies and investment strategies that we deploy, as well as other operators deploy when they're investing. And you want to pick something that really intrigues you, something that really interests you, that you have a high level of interest in, because if you don't, you will stop and you will not move forward with investing. So whether it's the types of assets that I do personally, which is a single family and multifamily side, or outside investments like self-storage and mobile home parks and things like that, that I personally invest in passively versus actively. So you can't be an expert in everything. One of the biggest challenges people do is they don't focus on an asset class that they can specialize in. They start spinning their wheels on all these different investment methods. So, and then the most important aspect is managing your investments after you own them. So unless you manage them, they will manage you, and the managers will manage you. So, and then I think one of the most important aspects of this is helping others. If you help other people without expecting anything in return, it will come back to you. The money will flow if you have a higher purpose from what you're doing. So keep that in mind. I know it sounds a little off when you're dealing with a capitalistic type environment, but realize that the more you teach other people, the more resources you develop. And a lot of people don't even realize the resources that they have at their disposal. And so by helping other people, I can actually see a lot of those different resources and help others along the way. So let's get into the topic, okay? What is financial freedom? So a lot of people think, oh, financial freedom is X amount of dollars, a couple $1 million in their bank account that'll last them for throughout retirement. The primary, old investment methods teach you, and the financial planners will teach you, you need to have X amount of dollars because you need to spend this much a year, and so you end up dying broke. And they've had this same method of thought pattern for a long time, when really the true steps to financial freedom come in the form of cash flow. And so you want to find a way to cover all of your monthly expenses, your mortgage payment, taxes and insurance, utilities, your savings, and your children costs through cash flow. You want to pay for all of those expenses. And if you say have $6,000 a month in living expenses, you need to have over $10,000 a month in passive cash flow coming in, because you have to reinvest that difference to keep up with inflation as inflation continues through expenses. Food has gone through the roof lately. All these, you remember 20 years ago when you could fill up your gas tank for $10 and now it's 60, even though we've had some good gas price reductions lately, but of course there's going to be more gas taxes associated with that too. So keep in mind, passive income is the goal. You want to strategically set yourself up so that every single expense gets covered one by one, and you have these little wins along the way to help your momentum keep moving forward. So you buy a property that creates $200 a month in cash flow, allocate that to your cell phone bill or your TV bill, or your car payment, so that you have these little wins along the way. Okay, that really helps you with that momentum and that goal down the line. You have to know what your total expenses are so that you can know what your goal is as far as cash flow goes. Okay, so the biggest problem is that the traditional investment methods, the mutual funds and CDs and stocks and bonds, don't produce enough cash flow for you to achieve financial success and enough cash flow to outpace inflation. So when you're dealing with CDs that give you a 1 to 2 or 3% interest rate, which I'm being very, very conservative with those interest rates that they're giving you, they're not producing enough. Inflation at the very minimum is 3%. People actually go through and say it's closer to 7 to 8% as far as inflation goes. So you want to create income streams that create a higher cash flow than inflation. So, and what do those old investment methods produce? 1% of those retirees over the age of 65 are self-sustaining, and 16% are still working. 31% are dependent on relatives, and 52% are dependent on charities in one way, shape, or form. So that's what these investment methods are producing. But you've got the educators, the Schwabs and John Hancocks and Fidelities, that control the investment education, and they're the ones advertising in Money Magazine and Entrepreneur Magazine saying the new cash flow investment now, make 3% on your money. And it's really interesting because I start laughing every time I go into a bank or a financial institution and they say, invest in our CDs, we're going to pay you a 0.5%, which, by the way, our fees are more than that. So be very, very careful when you're investing in these other investment methods. They might be a good strategy for a diversification approach, but in my opinion, if you specialize in different asset classes, there is no need to necessarily diversify if you know what you're doing and understand the risks and can mitigate those risks. So let's talk a little bit about some of the assets that do work, okay? Obviously, the stuff that I invest in, the single family and multifamily real estate investments. Passive businesses. So you notice I said passive businesses. We all know what an active business is, being self-employed. A lot of people on the call probably have read the Rich Dad Poor Dad book and said stop being self-employed, which, the typical strategy is, or the strategy you should be abiding by is working towards building assets that produce income, whether you're working for them or not working to trade your time for money. So successful people really do work hard. They just go through and work towards buying more assets that will create additional income for them. So promissory notes, syndicated investments, also very important real estate based assets. self-storage, mobile home parks, industrial properties, laundry facilities, ATM machines even. And I threw in ATM machines because I absolutely love them. They can create a really high cash flow, and I invest in them myself as well. I just look at cash flow type assets, even though those aren't real estate based. But these are different asset classes that you can produce for yourself and focus on to be able to create this passive cash flow for yourself. But before you actually do that, there's some specific requirements that you need to do outside of your investing to be able to really become financially free. And you can't just expect to do this on your own. So, it's really important to go through and focus on, these specific things that I'm going to be talking about. So the first thing here is, what is your why? So your why is extremely important. If you don't know what your why is, then you're not going to be able to achieve that financial success. You're not going to have the push to be able to get there. Okay, so it's looking at something you believe in, looking at something that is above yourself that you can actually achieve. What is the reason why you're doing this? So, if you had all the money in the world, what would be your end goal here as far as achievement? Would you be, I'm looking at being able to create a financial education school that may be free to people that are in poverty that cannot afford this. And I focus on this because it's interesting to me. I have a son that's 9 months years old, and I bought him Cash Flow for Kids. Here's a picture of him right here. He's a little stubborn in this, looking at me going, Daddy, why are you not letting me out of this or out of this car just yet? Because he rolls around like crazy in this thing, and I absolutely love teaching him everything I can. And the Cash Flow for Kids game, I let him play with the actual stuff so that way he can learn a little bit now, even though he doesn't know what he's doing yet. So, but so goal setting, in addition to your why, you have to come up with what your goals are. If you don't know what your 30, 60, and 90-day goals are, and your 6-month and your 1-year goals, and even your 10-year goals, how do you know where you're going? You have to be able to set up a plan. So for example, I have a strategic plan that I put together where I'm focused on multifamily, single family assets, investing in notes and syndications. And my goal is $100,000 a month in passive cash flow and flipping 10 properties a month on a consistent basis. So that's my end goal. But what is my real life goal as well? Is it spending time with my son? Is it spending time teaching other people? Is it spending time helping the community? What is it? What is something that's above yourself that you can achieve and set a goal for if you had all the money in the world? It's not just about the money. Okay, you have to have that significant why in your goals as well. And then you have to learn financial education. I can tell you, even working at a CPA firm, I did not get the financial education that I got working for myself, learning the different investment strategies, learning how money works. You still live paycheck to paycheck working for, even a high level job a lot of times. And so you want to focus on how money works, interest, loans, that collateral and paperwork that really go with it. And the only way to really do that is to do it yourself and actually go through the process of buying properties, going and learning and taking education courses on a consistent basis, basic money management and tracking, training your mind. Every day I look at my affirmations. I try to read something that's going to better myself on a consistent basis. There's some great sources to be able to get this information. We have a lot of webinars and things like that through my For Investors by Investors investment clubs and podcasts that you can use on. They're on forinvestorsbyinvestors.com. There's some great other sources out there, like Bruce Norris has a great podcast. Jay Massey has a great source of investment or investment education for clients as well. So they're great strategies to actually implement to be able to learn and strategically do this yourself. So learning how these different investment methods and assets work is key, as well as learning how to mitigate the risk for yourself. So those strategies and the risk mitigation, you're not only learning it for yourself, but you're learning it to be able to raise capital from other investors and train them on how to mitigate their risk. Because how do you expect to raise money from other people without being able to share with them how they are protected in the first place? Okay. Let's get into personal budgeting. The funnest part about the whole presentation right now is personal budgeting. I'm telling you that 99% of people do not have a personal budget. Based on my experience dealing with people, they don't have something set up where they come up with their initial budget, which is always wrong. Okay. You're never right on the money with your personal budget, and they don't track it versus actual. So, you want to go through and you want to track every dollar you spend on a monthly and annual basis. It's easiest to update it on a weekly basis. I don't care if it's, you can do it in a number of different ways, but you also want to track that budget versus actual, okay? And constantly say, okay, why was I off on this number? Was it a large expense? Did I go on vacation? Am I planning for a car in the future correctly? Am I planning for my first house? What are the different large expenses that you need to be planning for? Very, very key when you're learning your budget and learning how to strategically develop your goal, right? This budget is your goal for cash flow coverage. So you want to pick up all of your tracking documents, use your credit card statements, your bank statements, track your cash transactions. I try my hardest not to use cash if at all possible, because they're so much harder to track and implement than credit cards and bank statements and things like that. But compile that stuff on a monthly basis. It's actually pretty simple. You just pull your stuff and then put them in one of these different tracking methods, whether it's QuickBooks, Quicken, Mint.com is a great place. It actually syncs all of your personal stuff together. If you don't want to deal with the software, Excel, or there's different expense apps that you can use. And if you really feel like you're not going to be able to do this, it is yourself, it is 100% worth it to pay someone else to do this for you. If it costs you $100 a month to pay someone to go through your stuff and basically put it into categories for you and budget yourself to give you that knowledge, then that is what puts you to the next level and knowing exactly what you're spending every month so that you can actually achieve that financial success. Without doing this budget, you will not achieve it. It will not be attainable for yourself. Every successful business owner does a personal budget and a company budget. And I have a template, an Excel template that you guys can use if you don't want to use one of these QuickBooks or Quicken or Mint.com. If you email me, I will go through and send that to you. In addition to your budget, your personal financial statement is very key. You don't know where you're going if you don't know where your starting point is in the first place. It's extremely important to have this personal budget this personal financial statement put together. What are your debts? What are all your liabilities? What are your assets that are currently producing income for yourself? What about your job? So you want to do a cash flow statement in addition to your balance sheet and your income statement. Your budget is your income statement. You actually have all of your income on your budget in addition to your expenses. And then you have your personal financial statement for your starting point. You look at it at the beginning of the year or the beginning of the month, the end of the month, and do this annually as well so you can gauge how far you've come with developing more equity and more assets for yourself, okay? And then the last and final thing, your biggest expense is taxes. So planning for your taxes on a consistent basis. I can't say enough how important it is to pay someone for financial tax planning, okay? Financial and tax planning. They will save you tens of thousands of dollars by doing this if you go to the right person. If it's painful to pay a couple $1,000 for a whole year of tax planning for yourself, but I can almost guarantee you if you have any kind of complexity at all that they will save you money over the money you're paying, okay? So let's talk about structuring. So how do you structure yourself for success and for that tax planning component of things, okay? So there's two components of structuring: the legal aspects for protecting yourself. So the liability protection, you're trying to solve someone from suing you. So you can put your properties in an entity to protect yourself. You have a corporate veil or an LLC veil there to protect you in case of lawsuits, as long as you do everything right. There's various entity types from LLCs to S corporations to corporations, partnerships. There's a ton, and each one of them has different legal protections or lack thereof. So it's important to understand this, and I can urge you, please do not go form entities before you own any assets, any real estate. There's too many attorneys out there that will go say, hey, go form your LLC or go form your S corporation before you've done anything. And what happens is you end up, the vast majority of the people that I see will end up spinning their wheels for a long period of time. Maybe they cost them an extra $1,500 for the year and a tax return and an $800 California franchise tax or something along those lines when it really wasn't needed. Go and acquire the asset first and then go put it in an LLC afterwards, or get it under contract. It only takes a couple weeks max to get your entity set up. You can be doing it inside of an entity. You can make your offers in the form of your name or assigns. And when you do that, you can actually assign it to an LLC that you set up during escrow. So there's no reason to necessarily go set all these entities up first that add complexity, add costs, and really can cost you a lot of money when some attorneys will tell you to set them up when they shouldn't so that they can get paid for the operating agreement and things like that. Also, insurance planning, very, very important from a planning perspective. Going through and finding out what insurance you have in place and what quality coverage you have. When you're doing this type of investing, you want to make sure you have the right policy, the right liability protection. You want to make sure that they're covering everything they should be covering, like full loss of rents coverage, like full construction costs versus just depreciated value, meaning they pay you less because they say that your property is worth less now because it's a little bit older. So there's things like that that you want to look at when you're dealing with liability protection. And then we're talking about the taxes, okay? So learn what entities to mitigate these taxes. So it depends on the type of income you're making. So if you're making passive income through rental real estate or something like that, then usually an LLC is adequate to do that, okay? Now, or your own name, depending on your own situation specifically. So I can't recommend a specific type to you unless I understand your specific situation. So if you email me or call me, we can talk about this type of thing and go over it offline. So and then we have S corporations. So S corporations are more for active income that are subject to payroll taxes. So there's what's called a salary dividend split inside of an S corporation. When you have active income in your own name, you're paying 15% in payroll taxes when across the board on 100% of that income. If you have it in an S corporation, you can save 15% on about 66% of your income. Again, depending on how much money you make, there's some minimums there. So sometimes it doesn't make sense to set up an S corporation. But a lot of times, if you're making any kind of substantial income, it does. And then you have partnerships and C corporations. Partnerships don't really provide you any liability protection, and they're just flow through entities. C corporations can provide that flow through or can provide that liability protection, but it's not a flow through. You have taxes at both levels, at the corporate level as well as the individual level when you pull that money out. So, and then you also have self-directed IRAs and 401ks and Roth IRAs and pension plans that you can invest in. I've flipped properties before out of my own 401k plan. I actually invest in rental real estate and notes and syndications in my own 401k plan and my IRA. There's also HSA accounts, health savings accounts that you can invest real estate in and actually have all of that income be tax deferred or tax free inside of a Roth. So there's awesome strategies to be able to build your own retirement right inside your own 401k where you don't have to deplete the principal. If you build it large enough, you can actually live off of the cash flow and not die broke. So it's one of the most important things you can do is understand the cash flow strategy. Before doing any type of real estate investments, you need to build your team. Your team will make or break you, okay? So here's some of the team members associated with real estate or business in general. Your property managers, the number one important factor when you're investing in rental real estate. They will make or break your entire investment if you have a bad manager. Teams of rehabbers. I'm not saying just one team, you have multiple teams, because if you have one team, then typically the cost goes up over time, the quality goes down, the time goes up. And so you want to be able to pull that away where they know you're not the only one they're dealing with. Brokers and bankers, private lenders, affiliates, insurance agents. I've fired multiple insurance agents in the past for the lack of education that they provided me on my investments. I had them give me a owner policy on a rental property when they knew I was buying a rental property. So these are the things that you have to look out for. All these different team members are not in any way, shape, or form created equally. So even CPAs, you have really bad CPAs and really good CPAs, and you want a CPA in each individual market you're doing business in. If you're doing investments in different markets, you want a CPA in that market that can recommend what you should do based on that market specifically as well. Same thing with attorneys. You want an eviction attorney, you want a contract attorney, you want a syndication and securities attorney if you're doing that type of work. There's a ton of different attorneys that you should be hiring depending on what you're doing. Realtors, inspectors are not created equally either. You want to have an inspector that will go through every aspect of that inspection report with you and your contractor, giving you feedback as to what they really feel about that property versus what's in the inspection report, and also have pictures in the inspection report with a written description so that you can get a full understanding. So buying and selling agents, appraisers that can work with you and really educate you, bird dogs, and financial advisors. Through your team, the most important aspect of your team is how well they teach you. Okay, so if they're not willing to sit down and teach you and go over things with you in detail, then find another team member, because that's one of the most important things you can do, is finding team members that will help you along the way, and get referrals. Ask other people that have had tons of success with their team members. Okay, let's get into why real estate. This is why I quit my CPA firm job and decided, against the wishes of my entire family, freaking out because of some of these different factors, because I was making the wrong type of income. And I decided, hey, you know what? Real estate has all these ridiculous factors that give you competitive advantages over other types of investments or other businesses. So the very first and most important thing is leverage. And you're leveraging, most people think, okay, I'm just dealing with banks, but you can leverage private lenders, joint venture partners, as long as you know how to teach them how they're protected. So most people in the beginning, when I first got started, I didn't know how to raise $30,000. I didn't even know anybody with 30 grand for a deal or 40 grand for a deal that they could put up. But as I learned through my attorney's relationships, through taking different classes, and really learning as much as I can, I learned how to teach them how I protect them, going over every piece of paperwork with them, showing them this is how it works. You get the warranty deed, you have a promissory, or you get the deed of trust, you get the promissory note, everything gets funded directly to closing. There's a lot of different things that protect that investor along the way. So, and then you also can leverage team members and your own employees. So very, very important. You cannot do this all yourself. I have a team of people in California. I have a team of people in every market that I do business in. I have virtual assistants around the world that help me with these different strategies and help me to do different parts of my system. Without them, I'd be lost. So you have to hire people and work with different team members that are top notch, and they're as if you're doing the deal yourself. Okay? Inflation. Very, very huge. It's a giant inflation hedge when it comes to appreciation in the property, when it comes to rental increases in the property. Now, this could hurt you as well, but at the same time, in the long run, with money printing continually happening and it getting continually worse and worse, it's a great hedge because the asset value really actually stays the same value. It just actually becomes worth more comparatively to the dollar. So in reality, there's no real thing as inflation outside of supply and demand specifically. But when you're dealing with these different investments, you want to look at that in detail and make sure that you have a really good grasp about what's happening in that specific market, where the demand is, and things like that. It creates a higher cash flow than when you're dealing with other types of investments like stocks, bonds, and mutual funds and things like that. So very, very important to focus on that cash flow stream. Like I mentioned, it has that appreciation potential. Collateral backing your investment dollars. So if you're raising capital or you're investing your own money in real estate, you have a backing of a hard asset that reduces your risk. You have a piece of collateral. I personally would never invest in anything unless it had collateral backing it. And it doesn't make any logical sense. That's why I don't invest in the stock market, because I don't feel that it has any real collateral attached to it. It's so manipulated that, which you could say the same thing about a lot of different asset classes, but the real estate market seems to have that backup of that collateral that can't really fluctuate substantially if you're investing at the right time in the right market. Okay. Like California has a much higher volatility than, like a Memphis or something like that that has very low volatility as far as that risk goes. The tax benefits. You get some great depreciation benefits for investing in real estate. You can actually do cost segregation analysis and things like that to increase those tax benefits. Principal reduction on the loan. It's great for that long-term wealth building approach to investing. When you borrow funds, say you put 25% down or 20% down and get a bank loan, you're not just getting the cash flow, you're also getting the principal reduction in that loan, and you're using that leverage to bring your appreciation to the next level, bring your cash flow to the next level, and leverage that money to be able to really increase your cash flow returns and your appreciation returns. You can also get short-term profits too. So if you find a good deal, you can definitely go through and flip properties, and there's definitely strategies to utilize within real estate to get that short-term profits to keep the lights on. So I do both. I invest in cash flow and I flip properties, so that way I can do this full time and learn at an exponential level about cash flow investing and things like that. It's great to be involved in this business full time and learn how to build cash flow streams and build assets that create this cash flow, and at the same time keep my lights on and keep going with my family. Okay, leverage. Other people's money, the thing you guys learned about with Robert Kiyosaki and everything else, okay? And all the other books on cash flow. It is one of the fastest ways to wealth creation. It can also hurt you really badly if you don't know what you're doing, if you're not protecting investors. So the moment you stop protecting investors first is the moment that you actually start faltering and losing money. So, and you start losing those relationships as well and getting a bad reputation for losing money. Look what happened to Madoff, right? He was just a complete criminal on that side. And you have a lot of other people in the real estate arena that do things wrong. And so when they do things wrong, you have the chance of losing their money, these investors' money, which is losing a major asset for yourself because you built the trust up enough to get them to invest with you. And then if you do things wrong, then you can lose that trust overnight, immediately, and all that work that you put into it. Understanding the rate differences for new investors, this is key. When you're dealing with investors that don't have a lot of experience, they may be paying higher interest rates because there's more risk when you're dealing with those newer investors. If you're dealing with a more sophisticated investor, they not only are lower risk to work with, but they also can go through, and they have a lot more resources to go to as well because they have more capital sources. So you're going to be getting a lower interest rate when dealing with these other investor types, these other full-time or more experienced investors. So sources of other people's money, the banks, you have traditional and non-traditional banks, which non-traditional is someone that's not a Fannie Mae or Freddie Mac lender, meaning they're not going to sell their loans to Fannie Mae or Freddie Mac. They're going to keep them on their own bank's books and hold them in-house for their own cash flow. And then you have commercial lenders as well. That is a little different dealing with commercial banks, or let me say a lot different dealing with commercial banks than when you're dealing with a traditional homeowner house or investment property on a single family home. These commercial loans are less, give you a shorter term, typically pretty commensurate interest rates, but it depends on the specific lender involved, okay? You have private lenders and hard money lenders. I differentiate the two because private lenders are usually a lower rate. Hard money lenders are just that. They make it hard to make a profit on a flip or on a deal because the rates are really high. But these guys are professional lenders that you can go to at all times. You don't have to teach the deal to like you do on private lenders. Joint venture partners, very, very key. It aligns your interest with those other clients, with those other investors. Portfolio lenders as well, lines of credits, angel investors, all key to learn the different strategies of other people's money. Okay, portfolio lenders will actually put it in their own portfolio, and then you have blanket lenders that will loan across multiple properties at the same time. And leveraging your team, like I mentioned, with employees and subcontractors, outside team members, and your VAs. So you can go to Upwork.com. There's a number of other sites that you can go to for your virtual assistants, and you want to interview them in detail, okay? Analyzing investments, okay? So I'm going to start going really fast because I don't have a lot of time left, and I want to be able to hit a lot of these things, and these slides will be available in the future for you. So keep that in mind. I'll be able to provide these to you so you don't have to take tons of notes while going through. Okay, the first and foremost, before you start investing, you're looking at a geographic market analysis. So, and a lot of this stuff here you'll find in our monthly newsletters and things like that too. So like I mentioned, you don't have to write this down. We'll have a lot of this content there. So as well as the replay of this entire presentation. So looking at your neighborhoods, your demographics, what school district are you in? What does the job and unemployment situation look like? What are the taxes in that state or in that subdivision? What is the population, and specifically, what is the government doing in that area that will help or hurt your investments? What about the real estate market indicators? You have the renters to homeowners in specific submarkets. You have the affordability index, the rent to price ratios, the housing price index. You can go to ofheo.gov and see the housing price index, or fred.com, to be able to look at these housing price index charts on different markets across the country. Distress sales in the market, how many are there? Time on the market, how long will it take for you to sell your home based on your price in your market? What are the tenant landlord laws? I don't invest in cash flow rental real estate here in California because the tenant landlord laws are bad, let alone, you're not getting a higher enough return on investment when you're dealing with that too. Okay, so what are the taxes and the crime rates in that area? Property analysis. What do your neighborhoods look like on a more individual street by street level? Okay, are you buying in the hood? I don't recommend buying in the hood at all. You will lose your shirt if you buy in the hood. You have a lower quality tenant base that doesn't pay on a financial tenant base that doesn't pay as often. Okay, so your rental analysis, you want to look at comps in a specific area for being able to find what your rents are. Your renovation analysis. We get a room by room, side by side approach to our renovations. Market value analysis, your inspections, your tenant quality control. Are you doing criminal and financial background checks on tenants? Are you buying a property, and did that occur on those tenants? What does your insurance look like? Review your closing documents to make sure that you're actually going through and not getting charged all these other miscellaneous fees that shouldn't be there. Your risk assessment as well. What are your risk tolerance levels personally? You have to know that for yourself, okay? Lending analysis. So all of these things are very, very important when you're trying to understand your property in itself and what it's going to cash flow, okay? Which leads right into the profitability. You know, your lending leads right into profitability. What your cap rate you're buying at will give you your cash flow stream as well. So equity and flip analysis. Do you have enough equity to flip the property and get out of it if you needed to with your exit strategies? And what are your costs? Don't forget your profit on the back end, but there's a ton of costs involved too. So you want to make sure you understand what costs there are, like utilities and things like that that come up that you don't realize. Okay, let's go over a little bit about the exit strategies. You have buy and hold. That, in my opinion, is an exit strategy initially, okay, because you have a long-term hold process where you never have to sell it because you're not buying something that doesn't cash flow on a monthly basis. Fix and flip. Refinance the property. You can do seller financing to other investors, to homeowners. You can sell that property with seller financing, which is a great strategy to use that we use all the time. You can lease option that property. You can wholesale it off to somebody else. You can do a joint venture with somebody else to get your capital out of that deal. So there's a ton of different strategies that you can implement when you're investing in real estate as far as an exit strategy. Okay. Now let's go over some of the pros and cons of flipping. Okay. So some of the pros, very, very key here. Faster profits. You get higher cash infusions, which are great. They're less susceptible to market fluctuations because you're in and out really, really quickly. You have your capital is tied up for a shorter period of time. Don't have to deal with tenants. You have a higher return on investment because you're in and out quickly as long as you're flipping with a profit. Your other people's money is pretty plentiful on these short-term type deals, so you can find that all day long for these deals. I said pretend you're on Flip That House because it's a pretty glamorous, I guess, investment strategy. Everybody wants to become flippers, okay? So, but there's some definite cons to that as well. So, so when you're dealing with the cons, you're dealing with, you know, contractor issues, high carrying costs that you have to front. The transaction costs can be really high. You're in and out very quickly. You can have unforeseen things that come up under the construction side. You have to close really quickly and get this deal under contract and have the money ready and have everything streamlined and put together. It's very, very time intensive, and you got to deal with the code enforcement issues that come up on consistently. You're paying a higher interest rate usually on these higher flips, and there's some major tax implications. So here's an example of a deal that I did that was a major headache for me. I bought the deal for 59 grand out in Tennessee. I spent about 26.5 in renovation and about 6 grand in interest, and I had about 5,600 in rental income at the end of the day once I sold it. But the day after I closed escrow, the foundation cracked in half and cost me another $16,500. So my total cost ended up being about 110,000, and I could only sell it for 112. So I only made about $1,100 in profit in 9 months because it took forever to get this foundation done and everything else taken care of. So you know, that's a bummer deal when that type of thing happens and it eats all your profit. At least I made something on the deal. So, but definitely something to pay attention to. There are going to be deals where you break even or lose money. And if someone tells you they've never lost money in a real estate deal, either they're lying to you or don't have a lot of experience doing these things. So let's talk about holding, and I'll get to the story of this giant picture of stump in the top corner right there in a second. Okay. So pros and cons of holding property. Okay. It provides an inflation hedge. Great. Less work than flips because you're not having to resell the property right away. It can build that long-term wealth for you if you're holding a long-term, especially with leverage. It cash flows, has the appreciation, you know, all the stuff we talked about already on the previous slide. But then you have to deal with the cons, okay? What if, you know, you deal with bad management? You have to constantly manage the managers on a consistent basis. You have preventative maintenance that you have to allocate money for. So don't expect in 15 years that, your roof isn't going to need to be replaced, or 20, 30 years, you're going to have a replacement roof you have to pay for. So you have to allocate a capital expenditure for that in the future and take money out of your cash flow now to cover those types of major costs. You have tenant turnover risk. There's liability of getting sued when you're dealing with holding. There's costs of your entities and things like that. The lending can be a big headache when you're having to deal with all the paperwork and everything. You have the tenant legal issues, the theft and damage to your properties, especially in these bad neighborhoods when the tenant turnover can really kill you because everything gets stolen before you actually get the property rented. So that's why I don't buy in these bad neighborhoods, because you have major theft issues, vandalism issues, and things like that that can occur. So this stump, back to the story, this is what happened when we bought this house. So we just finished the rehab. My investor funded the money on the deal, and the day afterwards, this happened. And so luckily, our insurance company made us a giant profit on this deal, and we were able to rebuild the property for a fraction of what we were paid, and been able to make a great profit out of the deal. But it was very, very scary if you see a sequoia like this falling on a house. It's pretty crazy. One of the unique experiences you deal with after dealing with 500 houses. So investment strategies, okay? So let's kind of go over some of these things, okay? Single family homes, you have leasing and managing your manager you have to deal with. You have the preventative maintenance. You have long-term financing that's available, so it's a great strategy. And it's a lower cost, so it's a great entry-level asset, especially when you're doing like a 20 or 25% down type deal. You're not having to come with cash all the time or anything like that, okay? Multifamilies. They're great when you're trying to get to that cash flow goal way faster. So, you buy a single family home, you might make 250, 500 bucks a month or something like that in revenue. When you're dealing with multifamily properties, you can make 3, 5 grand a month in cash flow right out of the gate. So, getting to that goal is huge, but you have some learning curve to go through before you can get to the multifamily side of things, because your mistakes are bigger in these types of things too. So you have a larger upside potential, but that downside potential as well if you don't know what you're doing and don't have your proper teams. I would say test everything on the single family homes with your teams and then go into multifamily afterwards, because the mistakes hurt less on the single families. So you have a diversified tenant base. One tenant moves out, you got a lot more available. And then you have these capital expenditures and efficiencies you really want to allocate for, because a roof on a 30 unit is much more expensive than a roof on a single family home. Okay, same thing with HVAC units. You have 30 of those now on a 30 unit versus, one on a single family home. So much more important to allocate money for these capital expenditures. Promissory notes, performing and non-performing notes you can invest in. So definitely get proper advice from professionals, okay? You have lending to different professionals and beginners. So I talked about when you're doing private loans yourself to different people, when you're lending to professionals, you're probably going to pay a little bit lower of an interest rate than when you're lending to beginners that are flipping. But your risk is much higher when you're lending to beginners. You can get short-term, like 1-year loans. You can get 6-month loans. There's 5-year loans. There's 30-year loans. I mean, there's really all across the board when it comes to promissory notes. I deal with a lot of seller finance strategies that are great strategies, and you can create paper. All your profit can be built right into the paper in itself, and you can create these spreads. If you go loan out at 8% and go raise it at 6, you can go make a 2% spread on your money there. So it's a matter of how much more money you can raise. You don't have to have all the money yourself to do this. Syndicated investments, like I mentioned, it's a pooling of private investor funds, okay? It can be passive. You're reviewing these different statements and asking questions on a monthly basis, run by these professional operators that have 20 plus years seasoned experience that you've done criminal and financial background checks on. There's typically preferred return involved, which means that you as an investor get paid before the operator. And if you're on the operator side, you can raise capital through syndicated investments too and get the right legal advice to set these types of things up, okay? So, and you want to review all of the assumptions in these syndications to make sure you agree with them. If someone says there's going to be appreciation in a market by 10% at this timing of the market, I would say that's a complete fabrication. So you want to make sure that it makes sense to you based on your timing of the market. Self-storage, it performs well in up and down markets because more people move during down markets as well. So you have a high cash flow when you're able to make them really efficient. And there's side income sources like selling boxes and selling and renting trucks and things like that that can exist. Businesses, creating them to be passive, like I mentioned, is key. And you can leverage others once you formulate a plan to do this. If you want to start an eBay business, you can set somebody else up doing it for you, train them on how to do it, and have them doing 90% of the work for you. So that's the goal with any kind of business. Mobile home park funds or mobile home parks. Really, the affordable housing is going to be in demand in the future as the middle class gets squeezed more and more. So, and there's a limited supply because states don't want them necessarily investing or in more and more mobile home park funds. Different states don't want to allow more mobile home parks. So, and there's really high cash flow on some of these mobile home parks. And then there's commercial property as well, which can be great strategies to invest. I invest in those through different funds and syndicated investments because I don't specialize in the commercial property aspect. So here's an example of a single family home that I typically offer clients, and this is something you can do for yourself when you're investing. I offer 4 options: the cash, bank financing, seller financing, and joint ventures. So this deal is a 2,000 square foot house, 3-bedroom, 2-bath, rents for $1,075 a month. After all your rents and vacancies, management, taxes and insurance and repairs, you're looking at about $675 a month in net cash flow if you bought it all cash. So if you buy it with bank financing for $116,000 purchase price and put 20% down, your net cash flow is going to be about 9.88% on the money at a 4.75% loan amount. Or your total ROI is going to be about 16.05% with the principal reduction on the loan as well. So you want to include that principal reduction to understand your total loan. You can do a cash purchase. This is at a 7 cap. So this one you would make 7% on your money. I offer a seller finance strategy at a slightly higher price because I have to sell these notes on the secondary market to enact them. And we're looking at about a 6.7% ROI with 50% down. I sell a lot of these to international clients that can't get U.S. financing, or 401k plans and things like that that are harder to get financing. So all of our assets, which is something you should do as well, is we put a full property package together for these things with the before and after pictures, the property layout, all the comps for the rents and the comparable sales, disclosure checklist. We do side-by-side reports of everything in that inspection report being done, shown to that investor up front before they buy the property. We do rehab estimates, financial projections for them. So, and we do the full comps, like I mentioned, on the comparable rents, the comparable sales, the square footage analysis, and then we do a disclosure checklist where it shows the rehab completion date. It shows the age of the roof, if it's certified or not, the HVAC certifications, when they are new, all of the type of plumbing when they're new, all the appliances that we put on the property and when they were replaced, as well as the tenant move-in date, the deposits, all of that stuff for full disclosure. So if you're buying properties, these are the things you want to look at to make sure you're buying something with all the preventative maintenance done, so you don't get hit with a $5,000 bill, 6 months in or a year in or 3 years in that you weren't expecting. Here's an example of a joint venture flip. I break down all the costs here on a deal like this, where we're looking at about a $72,000 all-in cost. My investors are making, if my investor puts up the capital, they're making 10 to 13% on the deal. Okay, and I do a 50-50 split on the profits and a 75% split to the investors on the cash flow because I buy them, renovate them, and tenant them. So these are the different strategies that I deploy on my side. Might give you some good ideas for what you're doing on yourself as well if you're not working with us. So here's an example of a joint venture with bank financing where we're doing a 75-25 split on cash flow. And this is where I'm talking about the structuring of these deals, okay? This is a little unique that we do. We do a 50-50 split on equity, including principal reduction in the loan. We manage our joint ventures instead of an outside manager for 8% instead of 10. There's usually a 10% plus cash flow stream on these joint ventures. Investors get the depreciation benefits. OCG is the team member, which we have a ton of experience doing this. And then we sell it at our cost. There's no markup. So our interests are completely aligned here where we're making our cash flows with you. So we bought, renovated, and tenanted the property and bring existing equity to the table. And then investor puts the down payment and qualifies for the loan. So this is a really high-end property that we've done. It's a 3,200 square foot house, 4 bedroom, three and a half bath, built in 1995 with $2,095 in rent at a 4.75% rate, which we're seeing about 4.625 right now, and 30-year terms. You're looking at, and I'm sorry for all the numbers, but bear with me, I'm an accountant here, okay? So the cap rate is about 8.16%. The cash flow to investors is about 11.8% cash on cash return. And then we have cash on cash plus principal reduction on the loan of about 14.89% for investors. So great cash flow on a very high-end asset with a high quality tenant where if they mess up your house, we can go after them. We can actually collect on a judgment with this type of tenant that has a good quality job that we can deal with, and we get $2,000 plus security deposits on these properties as well. Here's a multifamily that I did and already sold, 12 units. They're all studios and one bedrooms, right in the best part of Memphis. We fully renovated it with the foundation, the roof, the plumbing, electrical, all brand new windows and doors, all brand new tankless water heaters, subfloors. I mean, this thing was completely gutted, and it rents for about $9,100 or $9,200 a month. I was selling it for $985 or a joint venture for $895, and it makes over a 9% cash flow return and 11% when you're dealing with the cash on cash or the plus principal reduction. So this is a amazingly quality asset with 100% of the preventative maintenance done in a prime area of Memphis. And this is what we do to all of our multifamilies, because I want a good long-term asset that I don't have to do anything to in the long run. Here's an example of a promissory note that we've done, where basically I had an investor buy this from me for $145,000 and put $85,000 down, and my current note balance is about $56,000, and I loaned it to them at an 8% interest rate, okay, amortized over 15 years, and with a balloon at 7 years. So my balloon is $41,000 at an 8% rate, and so my return on investment is pretty high here. I'm making over 20% on my cost. So this is the type of thing you can do when you're dealing with seller financing to different clients. Okay, here's another example of a promissory note. So we have here, we have the $165,000 property with a loan of 105 at an 8% interest rate. That's a 63 or 64% loan to value of the property. So our investors typically make 6 to 8% rates because we have a lot of investors. I raise like $500,000 a month for different clients. So I have a very large investor base. This is a 5-year term. This one here is a 77% loan to value property for a 1-year term, and I'm using it for a flip deal that I'm doing. So these are the types of promissory notes that are available, and you don't have to deal with toilets or termites or tenants or any of that stuff, and you can actually get a no headache type cash flow with that equity appreciation, where if you had to sell that property, you could get all of your money back and then make a little bit of a profit yourself as well. Okay. These syndicated investments, these are the types of things that I invest in. None of these are available right now, but these are the types of things that come up on a consistent basis. A commercial shopping center in Richmond, Texas, 267 unit apartment building in Mesquite, Texas, the mobile homes, the commercial shopping centers, self-storage, retail centers, single family home flip funds that I put together myself, a note fund in Jackson, Mississippi. And typically all of these are run by professional operators. They have preferred returns to investors. They're all collateralized. They have 8 to 10% in cash flow returns, 14% overall returns, and then a 7 to 10 year term. And the typical minimum investments are $25,000 to $50,000. So when these come up, we bring it to our personal relationships that we deal with, and we raise capital for these types of investments when they come up after we've done all of our homework and we invest in them ourselves as well. But these are the types of things that are out there if you know what you're doing and can analyze these deals correctly. Okay. Okay, so now managing your investment. After you understand these different investment types, managing your investment is everything, okay? So you have to know your costs involved. What is your mortgage payment, your taxes and insurance, your property management? Is there a fixed management fee? Do they charge you all these other miscellaneous costs? Are there advertising costs? Are there markups on repairs? What are the move in and out costs associated with them? Can you increase rents? You want to come up with your projection of what it should be making, and then every month compare it to actual. So you know exactly if that's a winner investment or a loser investment, or maybe there's some fluke thing that you had to repair a water heater or replace an AC unit or something like that that messed up that cash flow. And so you weren't expecting those things. So you may want to take some of those things out or include them in the overall profit analysis initially up front. Managing the property managers, very, very key. If you let the manager just run with it on its own, on their own, they manage it just like they would, any other outside investment, and you're not that important to them, okay? So you want to go through and review those monthly statements. Track the tenant collections that are due yourself. Don't just rely on the manager to do that for you. You want to have an Excel sheet that you go through and put all this information on so you can ask these questions of them saying, what did you do to try to collect this? Did you send out notices? What are your procedures for collections? What are your procedures for renovating properties and rent readies and repair issues that come up? And keep up on those repair issues. You don't want to get double billed by accident. If a manager is doing 1,000 properties, it's really easy for them to make mistakes. So ask for that tenant documentation. Did they do the proper criminal and financial background checks and things like that? So did they notify you about any evictions, and how did you notify them about how you want it evicted? I say if they're not done, if they haven't paid by the 30th of the month, file the eviction and tell them we'll work with them until the eviction occurs. So that way we can continually make sure that they don't get too far behind. And that's when it costs you a ton of money, when managers don't take action fast enough. Okay, so you can always work with them, but file the eviction. And you want to tell them what you want up front. And like I mentioned, review those quarterly metrics, okay? And those annual metrics and all of your numbers and the tax implications and things like that, and keep those books up to date constantly. So, and a shameless plug, we run a bookkeeping service as well if need be. So keep that in mind. But you don't need it for your individual single family homes. But when you're dealing with larger multifamilies, things can get a little hairy. So you definitely want someone like that in place. So how you can make money with us? You can invest in trust deeds, make 8% on your money. You can buy and hold and do renovations and with us, and renovated properties with tenants in place. You can partner with us on joint ventures. You can invest in multifamily investments. You can make money with us finding us projects and raising capital. You can invest in different syndicated investments. We do a lot of real estate and tax consulting and the bookkeeping support. And then, really a lot of investors are just not sure what resources they have. And so if you sit down with us, we'll help you determine what those resources are. And you can sign up as an affiliate if you'd like as well. That we have a ton of affiliate relationships that work with us in different ways based on our needs and their needs. So bottom line, we make money with you. We don't make money. We make money when you make money. So, and I have a favorite quote talking about the financial education aspect by Robert Kiyosaki that says, "One part of me is a hardcore capitalist who loves the idea of money making money. The other side of me is a socially responsible teacher who's deeply concerned with the lack of financial intelligence among society as a whole." And financial intelligence is everything. You really, really want to become as financially intelligent as you possibly can. That's everything when it comes to investing. You want to develop a strategic financial plan for yourself. So in summary on the budget slide, assess your current financial situation, your assets, liabilities, income, and expenses. Find ways of reducing those expenses and reducing your taxes. Set up the right legal structures and increase your income in different ways. I don't care if it's selling something on eBay or Amazon or something like that. Get income coming in one way, shape, or form. Set those financial and life goals for yourself. It has to be a clearly defined aim and specific goal in place. And you have to have a really big desire for this. So if you don't want it well enough, if you don't want it enough, you're not going to get there. So, and educate yourself constantly through reading and asking for and reading and listening to audio tapes and books. We have some, we have Rich Dad Poor Dad. We have How to Win Friends and Influence People by Dale Carnegie. Think and Grow Rich. The Law of Success in 16 Lessons by Napoleon Hill as well, which is the first book for Think and Grow Rich before Think and Grow Rich came out. And you have to take action. Don't twiddle your thumbs. Get in there. Get busy. Get dirty with this work. You have to take that jump. Every single new investor leaps. And if you don't leap, you'll never get there, okay? And you have to connect with people that think the same way, okay? People that are rich, the middle class, and the poor think and talk about different things. Think about who your closest relationships are. Are you hanging out with them constantly? They are influencing you because they're influencing the way you think. Start hanging out with the rich people that talk about, that next investment they're doing or the next strategy they learned versus the football game that's on or things like that, which there's a time and place for all of that, of course. But think about who you're dealing with and who you're talking with on a consistent basis and who you're learning from. So I really believe the more you achieve in your life, the happier you will become. So the more fulfilled you'll become as well. So if you're sitting on the couch and watching TV, yeah, it's some great satisfaction, to sit there and relax sometimes. It's important to do that. But at the same time, realize if you got up and went to the gym, how great do you feel after getting through that temporary defeat of getting that temporary pain of getting to the gym and getting through that workout? You feel amazing. Now, what if you gave up that temporary satisfaction for 6 months now and you went to the gym every day? How amazing do you feel there? So the more you give up of that temporary satisfaction for the long-term satisfaction, the happier you become. And you think about that in every aspect of your life. If everybody knows what they should be doing, but when you realize, hey, this is how I'm going to feel afterwards, and you can pinpoint your exact feeling after you do it, it becomes a hell of a lot more easier to get your butt off the couch and get to the gym or read that book or go on a webinar like you guys are doing tonight. And I definitely commend you guys for taking this time out to learn these types of strategies and investing yourself and investing in yourself to further your education. I would recommend continuing to go to these different types of classes as much as you possibly can. So if you're interested in going to more classes, we have a couple of our For Investors by Investors groups are no sales pitch at all investment environments. I run the Long Beach and the South Bay group. In Long Beach, we have one tomorrow coming up on how to become a private lender or borrow from one. So we have a professional coming in that's going to be teaching all about that topic and what you can do and what you should or shouldn't do and what the laws are there. Very important to understand the legal aspects because, right, how do you protect your investors, right? If you're raising capital, you have to learn how to protect your investors on these things. The South Bay one, we're having on investing in real estate passively. I'm going to actually be one of the panelists here. We have a couple of other full-time passive investors. It's a Q&A and a panel discussion. We have the audience participation here. We don't have a formal presentation or anything. We actually teach other investors through their own Q&A in the audience. So that's on Tuesday, March 8th. It's always the second Tuesday of each month. And then we're doing a live brunch and learn event on Saturday, April 2nd. At the 17th Street Bar and Grill in Tustin on real estate investment strategies. We're having different investors come in that do and enact different strategies so people can do Q&A and ask questions about what they're doing and their investments. So that's it, guys. Thank you guys very much for your help today and listening to me and taking the time out to learn here. My contact information is right there with my email at invest@ocgproperties.com. If you have any questions or just want to sit down and talk and see how that we can help each other out, feel free to email us and we'll be glad to help. But that being said, thank you guys very much. Go eat dinner, spend time with the family. It's already getting late. I'm sorry for going over by 15 minutes, but appreciate you sticking around for the finishing of the presentation. Talk to you guys soon and happy investing.